The United States has just launched major strikes on Iran, and this isn't just breaking world news. It could directly impact your gas prices, your grocery bill, your investments, and even interest rates in the United States. Whenever conflict erupts in the Middle East, global markets don't wait. They react instantly. And that reaction can quietly move money out of your pocket. Here's exactly how that chain reaction works. Step by step. Part 1. Immediate market shock. The moment news of the strikes broke, financial markets prepared for volatility. Why? Because Iran sits near one of the most important oil routes in the world, the Strait of Hormuz. Roughly 1/5 of the world's oil supply passes through that narrow corridor. If traders believe that route is at risk, even temporarily, oil prices can jump within hours. And oil is not just another commodity. It powers transportation, manufacturing, agriculture, and global trade. When oil moves, the world economy moves with it. Here's the critical detail most people miss. Oil doesn't have to be physically disrupted for prices to rise. Fear alone can push it higher. Markets price in risk before reality even changes. Part 2. What higher oil means for you. Let's translate that into real life. If crude oil rises significantly, gas stations adjust prices quickly. You may see higher prices at the pump within days, but it doesn't stop there. Trucking companies pay more for fuel. Airlines pay more for jet fuel. Shipping companies pay more to move goods across the country. Those higher transportation costs are passed on to businesses, and businesses pass them on to consumers. That means higher grocery bills, higher online delivery costs, higher airline tickets. This is how global tension turns into domestic inflation. And remember this, we've seen this before. During previous global conflicts, energy spikes helped fuel inflation cycles that lasted months, sometimes longer. And today, inflation is already a sensitive issue. Part 3. Stock market reaction. Now let's talk about your investments. When geopolitical risk rises, investors often reduce exposure to risky assets. Stocks can become volatile. Markets may drop sharply or swing dramatically up and down. At the same time, investors often move money into safer assets. Gold prices can rise, U.S. Treasury bonds may see increased demand. This shift doesn't always last forever. But during uncertainty, fear drives short-term decisions. And here's something important. Market psychology can amplify moves beyond what fundamentals justify. Fear spreads faster than facts, and that can create sharper, faster price swings. Part 4. Cost of living impact. So what does all this mean for the average American? If oil stays elevated for weeks or months, it can slow down progress on inflation. Gas prices go up. Utility bills may increase. Food costs rise due to transportation and production expenses. Even if stock markets recover later, everyday prices don't always fall just as quickly. That's the frustrating part. Inflation tends to stick longer than market panic. And here's the bigger risk. If inflation starts climbing again, the Federal Reserve may hesitate to cut interest rates. That keeps borrowing expensive, mortgages stay higher. Credit card interest remains costly. Business loans become more difficult. Part 5. Longer-term economic effects. Energy shocks historically slow economic growth. When consumers spend more on essentials like gas and food, they spend less on other goods and services. That reduces business revenue. That can slow hiring. And in extreme cases, prolonged energy spikes have contributed to economic downturns. There's also the currency factor. In times of global tension, the US dollar often strengthens as investors seek safety. That can impact trade and global capital flows. So this isn't just a one-week story. Depending on how events unfold, the economic ripple effects can last months, even years. So the next time you hear about geopolitical conflict, understand what's really happening. This isn't just foreign policy. It's fuel prices, it's grocery bills, it's interest rates, it's your purchasing power. If oil spikes, inflation follows. If inflation rises, your dollar buys less, and markets will adjust long before most people realize what's happening. Understanding that connection gives you an advantage, because by the time headlines calm down, the economic effects may already be built into prices. In the next video, we'll break down which types of investments historically perform better during geopolitical crises and which ones tend to struggle. Stay informed, stay prepared.